been doing this for 20 plus years. He's probably one of the best in Chicago, I feel personally, and not just in Chicago and our company. You know, our company, and not just our company, but our industry needs more guys like this. I'm not just saying that because he's on with me. I would say that to anybody about this guy because like many of you on this call, and as you're learning too, I know we're all striving to be better. We're always working on that every day, but Todd has done a great job and always put the client first from day one, building his practice. He's built a very successful practice in this industry and in this company. He's one of our leaders in Chicago, and he does a great job, and he trains us on a lot of great things like he's going to be doing tonight when it comes to helping our clients. So again, the goal is always to just try to take away a couple nuggets that you can implement into your practice, because that's what it's all about, is what about you, right? And what about what we're going to do for our families and our families we help and our personal families as well. And this is a guy doing it. So I'm going to bring on Todd here. Can we give a thumbs up to Mr. Todd Kemp?
All right. Thank you. Thank you, Mario.
2 thumbs up.
Can you hear me okay?
Yeah, we hear you.
Okay, perfect. Yeah, that was a great preamble introduction there, and also just a lot of great points that you made there, Mario. You know, I feel very blessed to be in this industry right now. And gosh, I mean, so many people are out there applying for unemployment benefits. And, you know, for us, if you're focused in this business, I think it's, you know, I have meeting with the same or more amount of people every single week. I've never been more focused on building my practice as I am right now. And I just think we've gotten a lot more time now, you know, since we're not driving all over Kingdom Come, you know, I mean, right now would be a great time to drive. I could probably go to a gas station and they'll pay me to fill up. Did you see the oil prices are negative for May? Kind of crazy. But, you know, hey, take the time that you have right now and just soak up as much knowledge as you can, as well as start to really engage, because this is the new medium. We've already been doing this. We've already been transitioning to this medium for a long time. I'm really happy that we have. So without further ado, I'm just going to share my screen here. See if you could see what I'm doing. Could everyone see my screen okay?
Yeah, we can see that.
Okay, perfect. So I'm going to do a little case study tonight. And then we'll close up with Angelo. Angelo is going to be talking about kind of the next big event that we've got coming on, which I'm super jacked about for Saturday. But tonight we're going to cover a case study of a client that I've been recently working with, and so that encompasses some things that I think are foundational in nature, which is definitely why we wanted to cover it. Every single person who's on this call can definitely help a client like this. And so, you know, there's certain things that when you're helping clients that are, you know, foundational, or that would, you know, be consistent across the board for the most part. But there's an art to this as well. So there's no exact science, right? But there's a process. And I think the process that last week that Anthony had gone through in terms of, you know, how to talk about an IUL and you know, just that whole process is fantastic. I think it's a great foundation. So I'm not going to go over like how to get to this point, more so just, hey, let's digest an actual case once I've already gathered the information from this client. So there's a case for Bob and Mary. So I've changed the names to protect the innocent. Okay. Well, we have Bob, who's 47, Mary's 49, and they have 2 kids who are 12 and 14. Now, just a little background. I've been talking about just not giving up on people. This couple was referred to me like 6 years ago. Okay. I have yet to do a stitch of business with them. So just following up every once in a while, he emails me a question. I've always engaged. I've always been, you know, helpful where I can, you know, and probably too much. All right. Probably too much. But you know, now he finally got back to me again and said, oh, I can't believe we haven't done anything. We have this whole list of things we want to do. We've not taken action. It's all he's blaming himself. And so part of it was his wife had quit her job. She was making six figures. She wanted to start her own business, and so there was a big cash flow crunch, which definitely hurt their ability to start taking action on some of their planning. Well, so just recently, that changed a little bit for them, and also I'll dive in a little bit on some of that stuff. The financial facts here: Bob is an HR manager. He makes about $135,000 a year. Married the wife. She's just been in business for a couple of years now. So last 2 years, 14,000, 43,000. So looks like it was going up, but then it's actually her business is promoting for restaurants. So maybe that's not going to do as well. She was making $100,000 normally. Okay. So it just gives you a sense of where they were, and then a reduction in income, right? So they own a home. They have a $350,000 mortgage. Bob's 401k is worth about $350,000. He contributes 15%, gets a 6% match. Okay. Mary's old 401k that she had from her previous job is about $150,000. Has not moved it yet because we're taking step by step on their list of things. Okay. They just received an inheritance. So this is kind of the thing that's changed. They got an inheritance for $90,000 from their uncle that passed away. And they also have a $25,000 emergency fund. That's their assets. Liabilities, they have that mortgage, but they also have about $30,000 in credit cards. Since I've known them, they've never really kept a very good budget, and it's really hard for them easy for them to put away in 401k, but hard for them to stay out of credit card debt. So because they make money and they just figure they'll just refinance or, do something like that later. But definitely that's not a good amount of debt on credit cards. We did their dime method. And so here's the initial objective was they wanted insurance, okay, protection. So their initial objectives, they wanted life insurance definitely for Megan and also for him because he just has term through work. And they both want long-term care insurance. Both are equally important for them. And they also wanted to figure out what they could do with the $90,000 that was going to be kind of a safe place to kind of park it for now. And so in doing the dime method, we saw that we wanted to replace about $50,000 for D stands for debt and death, right? This is how we kind of, with the dime method, just as a refresher, what we're doing is we're just taking inventory of if we were going to assign some jobs to a life insurance policy, what would they be? That's kind of the way I always bring it up. What would the jobs be? If you're no longer here, you're not making a paycheck, you're not making money anymore, you're gone. What job would I assign to the insurance policy to make sure that it kept on doing what you used to do? What would those jobs be? Would one of them be pay off your debt? Yes. Would you want your income replaced? How much income would you need from her? How much income would you need from him? Right? So we figured out it's about $50,000 for Mary and about $100,000 a year for Bob. So about times 10, right? We know how to do that. The mortgage is $350,000. How do you want the house paid off? Now the education part, the parents have some money, so they've already kind of taken care of the education, so we don't have to worry about that as part of the dime, which is take some weight off to do that. And what we do know is that Bob has $1 million through work, and he's got $1 million of accidental death and dismemberment, and Mary's got $100,000 through Bob's job. Okay, so definitely there's a hole there because Bob recognizes, and I've made it clear, hey, look, just because you have something to work, when you don't have a job, right, you won't have anything to work, right? And so he totally gets that part. So now here's the challenge that we see here is that, and by the way, I should say that normally when we do these type of trainings, that if you feel like I'm going to pause, and then I'm going to pause for questions, okay? And that's where you can unmute and ask a question. So far, why don't we do that real quick? Pause for any questions that are meaningful to what we're talking about, because we're talking about protection here. There's other needs that they have as well, but any questions so far that's not clear? Okay, good. All right, so let's talk about what we might do. First of all, education, right? And what I've been doing, just to let you know, I've been for clients I'm about to meet with, and I'm going to be a lot more proactive on this, using more of as a marketing tool. moving forward, as many in WealthWave has, is mailing that How Money Works book to people with a nice little note in it. But what I've been doing is I've been doing that as part of my, hey, before I make a recommendation, I'm sending that book to make sure it gets to them. And part of the homework is they have to read the book. Okay, so, but I do, I'll just cover just some of the education I think is really powerful. By the way, to say I love the How Money Works book is an understatement. That book is man, this is the biggest time saver, and you know, for me, the best educational tool I've seen, along with the Blue Book. You can't go wrong. But let's just talk about the picture here, and this is in that book. Okay, this is a picture of what term looks like. Okay, because I look at, you know, this, their situation is they've got 90 grand. They want to use a portion of it to help them pay for their protection need. He recognizes that that could be used that way, okay? But they've got a situation where their income is still much less than it used to be, but their spending habits haven't really changed that much. So there's still some work that has to be done on that, in that arena, okay? So they can't probably do the entire amount of protection they need via permanent insurance. So this is a case where you start to figure out how to blend term with a permanent solution, okay? So let's talk about why term is good, because if anyone says term is bad, they don't know what they're talking about. Okay, if anyone says permanent's bad, they don't know what they're talking about. Or they only do one thing, right? They only sell whole life, or they only sell term insurance. You know, I'm going to tell you that, you know, you got to have every tool in your tool belt when you're going to build a house. You can't just show up to the house to build a house with a hammer in your tool belt, because every problem looks like a nail. And that's just not the case when you go to build a house, right? You got to have a screwdriver in there too, and other tools too. So term insurance is one of those tools. And so what does it do? It protects you. What does it protect? It protects you when you're young, kids are at home. It protects for college expenses if you pass away prior to them going to school and you're planning on helping them pay for college. It protects your mortgage. If you pass away, that can be enough money to pay off the house. And if you're working, so it protects you during your vulnerable income, high income earning years, okay? Term is something you use to protect timeline events. So your mortgage, it's one day it'll be paid off. Well, then your term could end for the protection on that. One day the kids move out of the house. Well, your term could end for the protection on that. One day you plan on living a work optional lifestyle, okay? So you're not working anymore, making that same money. Well, guess what? The term insurance that was protecting that bigger income doesn't have to be there anymore. So it's not something, it's like car insurance. You don't want to collect on it. If you collect on term insurance, that means you died way too soon, right? Okay, but it's also cheap. So it's something that so it's for a period of time, okay? And now when you look at the permanent insurance, which I love these pictures, by the way, in the book, it just tells a story so easily. Like, oh my gosh, it's like pictures, right? Okay, I get it. All right, so what does permanent do that term simply cannot do? It's not designed to do. Okay, it's not good or bad, just not designed for it. Well, number one, term is not going to provide you any kind of tax-free money down the road. It's not going to give your family a tax-free inheritance. It's not going to replace another kind of income during retirement. That is, when a couple are married, they're living in retirement, one of their incomes that's a very important income in retirement is what? Social Security, right? So what happens when one of the husband or the wife passes away? What happens to the other Social Security payment? It goes away. You think the bills get cut in half when that Social Security payment goes away? No. A permanent life insurance will help what? Replace that. Will replace the income that's left behind that Social Security payment was providing, okay? So that's income replacement during retirement. Legacy planning, okay? But one of the biggest components that's the most important, I think, the biggest
10 more
game changer the
minutes,
last 10 years.
Gabby.
I'm sorry?
Gabby.
Does someone have a question? Okay, someone's on mute. Term care is the biggest game changer in the last 10 years in this industry, bar none, not even close, okay? Every single person who's out there needs long-term care, okay? Whether they're one of the ones that'll be the statistic or not, they need to protect it, because can you think of anything else that's in your financial, besides death and taxes, that's as high of a likelihood of needing it than long-term care? It's about 70%. So, hey, if my money is going towards something that's going to take care of a 70% chance liability in my future, and guess what? Because of the kind of long-term care that we're putting with life insurance, right? This is now something that's not like the traditional I use it or lose it kind of concept, right? So let's just look at a couple of things here that can help us frame this for someone who's looking to protect themselves. Maybe they came into the conversation only thinking about life insurance. In this case, it's a little different. This client, his father, 15 years ago, had a skiing accident. And from that point, and back then they had long-term care policies that never ran out. Can you imagine? So way back when he got this policy, he had a long-term care policy that to this day, he's been in a wheelchair for the last 15 years, and he's got in-home care. So this family knows very important how big of a deal that is. Their family would have been wiped out without long-term care. I want you to think about all the people you know, baby boomers, who are taking care of their parents right now. How many people, when they can think of an example fresh in their mind, whether it's their own family or someone else's family that's dealing with the tragedy of long-term care and how it's completely devastated them financially. Everyone's got that story, okay? So how are we gonna handle it? Well, first and foremost, let's just talk, the easiest part here is the term, okay? The term insurance, for me, it's a no-brainer. Look, very rarely am I going to offer term insurance that's does not have a living benefit. For an extra few dollars a month, can you imagine if someone got cancer or heart attack or stroke, didn't die, and didn't have living benefit that you could have offered them? How terrible that would make you feel. It's already happened in my business several times. I've had one client who had breast cancer. She beat it. She's healthier than ever. But because of the mortality table, what the mortality rate did, because of how the insurance company said that she would be, her life expectancy would somehow be reduced by this, she got a check for $56,000. You think that'd help pay for some stuff? This works big time. The thing is, most people, vast majority of people, are not going to die during the term. Term is the most profitable product an insurance company can sell because people don't collect, okay? So what's the odds? In this case, these clients are 47 and 69. I'm sorry, 47 and 49. I'm looking at, they want to be done in 15 years working. Their daughters will be 27 and 29 years old in 15 years. So I'm recommending that for part of their protection to be a 15-year term insurance policy with living benefits, okay? What is this? What does an LB term cover? If you have any critical illness, there's a whole list of things, but these are just a few of them you could see on the screen, that if your life expectancy is reduced, by the degree that it's reduced or how severe the critical illness is how big of a percentage of your death benefit that you can receive while you're still alive. So would everyone agree that having any one of these things happen to you is above and beyond highly more likely than dying, correct? So it's just a much better chance of collecting on a term policy, okay? Chronic illness is very similar triggers as long-term care, very similar. The same of these 6 activities of daily living plus cognitive impairment. That's what triggers it. And then it's the same kind of concept. So it's a way to collect on that term. If they die, then the death benefit pays out, okay? So that's a living benefit term insurance. I'm gonna show you how I combined it in a second, okay? But let's look at Nationwide. Nationwide has some really good tools here. This first one here is a generic kind of brochure that just describes the generalities of needing long-term care. that most people end up wanting to stay at home because it's cheaper to do that, and most people like to be at home anyway. Talks about the options here. I'm not going to read the whole brochure. You can just go on nationwide.com and download it. But health insurance does not cover long-term care. Gets rid of all the preconceived notions people may or may not have. Medicare covers 100 days in the hospital. Medicaid, you have to be broke and have $2,000 to your name to qualify, and then no one wants to get taken care of by Medicaid. Your adult children, oh yeah, my kids will take care of us. Really? If they have a job, do you think they want to quit their job? What about they have little kids of their own to take care of? Okay. Oh, I'll just pay for it out of pocket. You're going to pay in 20 years, 90 grand a year from your retirement, right? Well, I guess you could do that if you were wealthy enough, but even the wealthiest people like to have other assets or pay for those things before their own financial investments. Okay. And the last thing is, well, you can have long-term care coverage. All right. So then it talks about there's 3 different kinds of long-term care. You have life insurance policies with a rider. That's if leaving a legacy in life insurance is just as important as having long-term care protection. Okay. The next one, which I really like, is linked benefit policies. I'm not going to get into this tonight, but this is Care Matters. Care Matters 2 is one of the best policies I've seen out there that has a long-term care benefit that's more robust. You can add inflation riders on it, but also pretty much if you pass away, you're going to get all your premiums back that you put in and then some. And then the last option here is standalone policies, which they said, hey, it's an option. You don't care about getting any money back. Why don't people like long standalone policies, and why is that a dying industry? It's okay to have one in your back pocket if you like, to have one to show a client. I could almost promise you'll never get picked in a lineup of long-term care options. Why? Because if you don't use it, you'll lose it. That's the biggest thing, right? You pay for years and years and years, and pay what, by the way? The insurance industry had a tough time pricing long-term care. They didn't realize how much it was going to utilized. Number 2, they didn't realize how many people would keep their policy. Okay, and then how many people are just getting really old, living a long time with long-term care. So all the people using it, what happens to the premium of the people who haven't used it yet? It's health insurance. What happens to health insurance premiums when a lot of claims are being made? Any kind of they go up, right? So the premiums are skyrocketing, not like 3 or 4%. Like last year, I think it was like 30, 35% in many cases. Can you imagine you're in retirement, you get a 30, 35%, 40% increase in a bill on a fixed income? Probably not the best thing a lot of people want, okay? So what we want to do is talk about, this is showing the long-term care 2 policy. These are other brochures. I'm not going to go through the brochures, but we're going to couple for this particular client, since they have a need for long-term care and for life insurance, both. I'm making a recommendation that they should own a IUL. Now, there's 2 different kinds of IULs. Again, right, for Nationwide at least. There's one that's more for an accumulation. If anyone's been on a webinar, you know this stuff, right? There's one for more accumulation. That's for someone who's looking to really use the benefit later on, your cash value, to help supplement your retirement income on a tax-free basis, okay? And then there's one that's more designed for more the long-term care side, okay? Not so much robust on the accumulation of cash, really more of a goal of maximizing your death benefit, maximizing the long-term care benefit, minimizing how much your premium would have to be to pay for it, okay? In this case, I'm choosing the Protector 2. And the reason I'm choosing the Protector for this client is because they've had a history of challenges with first, 2 reasons. Number 1, they've had a history of challenge with credit cards and budgeting, okay? So it's really hard to ask someone to just put $1,000 a month or something like that away into an insurance policy that they can't. That a lot of times they're paying credit cards every month, right? So that's one reason. Another reason is their age. They're 47, 49. You need usually about 20, unless you're a doctor, unless you can shovel in the max amount. you're a doctor, you're a professional, you make a lot of money. You need at least 20 years for an accumulation type IUL to really work out for you. 15 years maybe if you really fund it. Okay, so for this client, I'm looking more for how they have a bigger interest in using their financial energy of their premium dollars to pay for the long-term care aspect. Okay,